education. Just before I start, most of you know, any of you who know me, who've seen me speak before, who've taken a class, who've been a member of the Austin Women's Investing Group, know that this is just, what I believe is one of the most important tools in your toolbox for building wealth. That said, it's a tool for your toolbox, right? This is not meant to be a hard sell to convince people to jump into the market, to become fans of the stock market. It is purely educational. I will tell you what I think and why I think it. And hopefully for those of you who are already trying to navigate the stock market, kind of put a framework around how you can view your investing strategy going forward. So that's how I'm approaching it. So this slide deck is a little bit stock market for beginners or intro to the stock market, just to get as many people as possible up to speed. And then as we kind of get through the slides, I think there will be some more, not necessarily more advanced topics, more sophisticated professional ways of looking at the stock market that hopefully you can use as you make your decisions going forward. But, as always, I mentioned this before, this is not individualized investing advice. This is just information for you to take when you're making your own investing decisions. So without further ado, here we go. We'll post the slides to the Meetup group and the Facebook group, so you'll have time to read all of this disclosure language. Most of this is some variation of past performance is not indicative of future results. And so what that means in investing, it's a really common caveat we attach to almost everything we say, is when we're talking about investing and finance, it's forward looking. I know many of you have heard me talk about this time and time again, but I'm going to keep saying it because it's important. We're looking forward. That's what investing is. It's trying to make decisions today based on what we think will happen in the future, but we don't know what's going to happen in the future. So we use the past to try to give us a frame of reference or a semi-accurate guess as to what is going to happen. But obviously the future is not going to be just like the past. Because of our human brain, we're trying to spot patterns all the time. And we're trying to put this brave new world that we're all in, we're trying to make comparisons to things that happened in the past. But obviously we're creating our future as in real time as we go. So it's not going to be perfect. But again, we're doing the best we can. So all of these kind of disclosure statements, most of them are some variation of that theme. Like we're using information from the past in order to make decisions about what we're doing going forward. Then there's some risk reward trade-offs. So please go back when I make these slides accessible, read all of these little disclosure statements, and then use them as you will. This is an introduction about me. I'm assuming you all know me or can link in with me on LinkedIn. I'm the founder of the Austin Women's Investing Group. I'm also an investment advisor with Blackburn Financial, founder of Blackburn Financial. So that means I'm an investment advisor representative during the day. This is what I do for a living. And again, when I'm advising people, I tend to approach the investing landscape through the lens of growth. How can we get the growth that we need in order to have enough money to either be financially independent or put ourselves in a good position to fund our retirement or achieve the goals that we've laid out either for ourselves or our families or our friends or our communities. So that's why my particular focus is on the stock market, both in my business and here when I present to the Austin Women's Investing Group. Before we start, we're going to start with kind of the basics of finance and investing. I know many of you have already seen this. I'm going to go through it again. I can't help myself. But when we're talking about investing, when we're talking about finance, the concept that we use over and over again is the concept of compounding or time value of money. So it's the idea that your time has value because your money is hopefully earning money, and then that earnings is earning something on top of it, and your money is growing over time. So there's only 5 inputs in time value of money. And the idea is that you come up with assumptions for 4 of the inputs and then you solve for the 5th one. This is how you calculate your amortization table for your mortgage or your student loans or your car payment. It's what every retirement calculator is based on. It is just probably the most well-known concept in finance and investing. And it's something that even beginners can start getting, a little bit more comfortable with. So the 5 inputs are present value, or what something is worth today. When we're talking about investing and retirement planning or long-term planning, your present value is what the value of your accounts is today. So it might be 0 if you haven't started yet. That's fine. There can be a 0 in there. In this case, we're starting with a lump sum of $10,000. So you have $10,000 to invest. The next input is rate of return. So this is how fast are your investments growing? Or really, when we're talking about investing, how fast are we expecting them to grow? So here, we have a couple different assumptions in our scenario analysis. The third input is payment. So when you're saving for, I'm just going to keep saying retirement, but it can be any goal. When you're putting money into an account, this is a positive number, or 0 in this case. And for this scenario, I'm assuming that there's no money going in, but there's no money coming out of this account. When you're in retirement, it's the amount of money you're taking out of your accounts to supplement your income. So payment is an input. And then number of periods, or when we're talking about investing, it's usually number of years. This is how long you're letting this thing happen. So here in this scenario, I have a couple different inputs, 10 years and 30-year time horizon. It can be months, it can be days. For the purposes of this exercise, we're going to talk about years. And then there's future value, what we expect something to be worth in the future. So the idea is you come up with assumptions or numbers for 4 of these, and then you solve for the 5th one to see what the answer is. You can use a financial calculator. You can use Excel to build a model like this, or you could just Google time value of money calculator and build your own. But here we're going to do something that's pretty simple. We're just going to see what the future value of our accounts might be under some different assumptions. So in the upper left-hand corner, we have an account. Let's say it's worth $10,000. We have a $10,000 lump sum of money we are trying to invest. We come up with an investment that we think will give us about a 5% rate of return each year, or however many years we're doing it. The payment is 0 under this scenario. We're not going to put any more money into the account, but we're not going to take any money out. And we're going to do that for 10 years. We're going to let the money sit and grow for 10 years. So when we plug the numbers into our financial calculator, we come up with $16,289. So that's what this account should be worth under this set of assumptions 10 years from now. We go to the upper right-hand corner, we still have our $10,000 and our 5% expected rate of return. We're not going to put any more money in the account, but we're not going to take any out, so our payment is 0. But now we're going to let it grow for 30 years. So when we do that, we come back and the future value of that account is $43,219. Right? So that should make sense. You've let the money grow longer, so it's worth more at the end of 30 years than it is at the end of 10 years, right? That's probably fairly straightforward. The bottom left-hand corner, now we're going to change one of the assumptions. We're starting with our $10,000 number. We're letting it grow now, now we're making a different choice. We're targeting an investment that we think will average a 10% annual rate of return. So now our rate of return number, instead of 5, it's 10. Again, we're not putting any more money into the account. We're not taking any money out. So the payment part of this formula is 0. And we let it grow for 10 years. Let's go back to our 10-year time horizon. When we do that, we come back, and this account is, hold on, my toolbar is right in the way. All right, so under this scenario, our future value is $25,937. So that should make sense too, right? If you compare it to the numbers above it. Instead of 16,000-ish, we have almost 26,000 because we got a higher rate of return over that period of time. So that should make sense too. Now in the bottom right-hand corner, we have our $10,000, our 10% annual expected rate of return. No money in, no money out of the account, but now we're gonna let it grow for 30 years. So I just kind of want you to take a look at this page, and based on the numbers you see, come up in your mind with what you think this number should be. Like, what should the future value of this be based on what you're seeing around it? You know, we would have a discussion about this if we were all in person, right? I will tell you that almost always people guess $80,000 or $90,000 or $100,000, right? Because it seems reasonable that if at a 5% rate of return, we end up with $43,000, at a 10% rate of return, we should end up with, 85 or 90 or 100. But the answer is actually really quite different from that. When we do the calculation, that $10,000 over 30 years invested in something that gets an average 10% annual rate of return turns into $174,494 because of compounding. So it's much, much more than most people guess. And this is the concept that underpins all of investing and underpins all of finance. How fast are we expecting our investments to grow? And so what you can take from this is, as we're all saving for our goals, under whatever our personal situation is, you have this choice to be more conservative and invest at a lower rate of return. In exchange, you'll get more stability. But you will almost certainly, unless you're going to inherit a ton of money, you will almost certainly need to save more money, right? Because under this scenario, our 30-year time horizon, there's plan A that our 10,000 grows to 43,000. There's plan B where it grows to almost 175,000. Regardless of what your investments return, you're going to need to get to a certain number by the time you retire in order to fund your retirement. I don't know, maybe it's $1 million, maybe it's $500,000, maybe it's $5 million. It actually depends on how much money you spend every year. It's a different version of this time value of money calculation. But $43,000 probably isn't going to cut it. So if you are not going to ask your investments to grow more for you, or you're not going to take the risk in order to hopefully get a higher rate of return, you need to save more money. What you cannot do and should not do, and please don't do, is be very conservative and not save money, because you will not have enough. Someone needs to do the work. Either you need to do the work of not spending the money and saving a lot, having a really high savings rate, or you need to ask your investments to grow more than they would in a CD or a bond fund or something more conservative. So just want to start there with where I'm coming from when I'm going through this, through the slide deck. All right, if we keep going, and we can certainly come back to this if you have questions on time value of money.
Sarah.
Yes.
I want to play devil's advocate because I had a friend who adamantly stayed out of the market and kept her cash in the bank. And the last downturn, 2008, she was like, oh, I didn't lose that much money. That wasn't that bad. And I remember thinking, wow, did she have the right idea? Was that the right idea? Versus being in the market, you get the huge loss, and you don't really know where you're going. So I was wondering if you could talk about that, because this is kind of another one of those times where some people want to stay in the market and others are thinking, well, maybe I shouldn't be in the market. So if you could talk about that a little bit.
Yeah, I mean, that's a really good question. So I think if I'm thinking about it mathematically, if someone has a balance, an account balance today that is large enough to fund the income needs they have in the future, then they probably don't need to take that risk if they don't want to. You know what I mean? It's like if you, and you can use time value of money to calculate this number. Like, okay, based on how much money I will need to withdraw from my accounts every year, if I plan on being retired for 30 years, I need to start with $2 million. Maybe I can even kind of put some numbers to it. If you are very conservative and you have $1 million already saved up, and you invest very conservatively, you can expect that $1 million in a CD or a bond fund to generate about $20,000 in income. So $1 million generates $25,000 in income. If that's enough, then maybe you don't need to take more risk than that, right? Maybe you have a pension or a low expense level, right? Like you don't have a very expensive lifestyle, or you have some other sources of income, and $25,000 for the rest of your life is enough. Then you don't have to take the risk because you already have enough money, right? Like, unfortunately, it seems like the trade-off is that the wealthier you are, the less risk you need to take, which is kind of a bummer because most people aren't wealthy, right? Or wealthy in that way. So it's always a combination of how much do you have now? Is the amount that you have now, when you calculate your present value, is it enough for you to reach your financial goals? I mean, there are really lucky people who are like, yeah, it is. I have enough. Right now, I have enough. I've got all of my future goals. They're sewn up. They're in the bag. Those people don't have to take risks, so they don't have to be in the market. But most of us aren't there, right? Most of us aren't at this place where we can just stop today, take our present value, and live the rest of our life. So I think there's that. Does that kind of answer some of that question? Do you think that I'm like onto something there, or is there?
No, I think so. That makes sense. Yeah, because it's basically totally dependent on how much money you think you're going to need. And so maybe she felt very safe in 2008, and she was really sure she did the right thing.
Yeah.
But maybe she also knew that she worked at IBM. Maybe she knew, oh, I'll have a pension and my expenses aren't that much. But I do remember thinking at the time, it's like, wow, she's sitting pretty right now.
Right. Oh my gosh, yes. That is certainly part of being in the stock market, right? Or like those periods of time when you're like, oh, I'm doing it wrong, right? But this, the rates of return that we expect in the stock market, they account for these scenarios, right? And we'll talk about that a little bit more. I think like if there's a chart on the screen, like you'll kind of see what that looks like in action.
Okay.
It's not 10% every year that you get credited like a CD.
Yeah.
Right.
Okay. Thanks.
Yeah, thank you. That's a great question. I've been thinking about that a lot too, because I think that is the exact question for people, like, why would I be in the stock market, right? If I can experience a 34% decline in 18 days or whatever it was, why would I do this, right? And so that's kind of what the purpose of like the coming slides are, is like, well, it's awesome if you don't have to, right? If you have enough money now, then you don't have to take the risk. Then you should sit in CDs and just do your own thing. No one has to do this, but it's a tool in the toolbox for people who need it, right? If you're trying to if your income isn't high enough or your asset base isn't high enough to get to where you need to go to have a comfortable retirement, how else do you get there? You either need to figure out how to make way more money, or you need to cut your expenses by a lot, or you need to ask your investments to do some of the work for you, or a combination of those things. Cool, great question. Okay, if we just kind of talk about the basics of the stock market really quickly. One of the most important things about the stock market is stock is ownership of a company. So this is really different from a lending relationship. If you have your money in CDs or have your money in bonds, it's a lending relationship. I'm lending you my money for some specific period of time. While you're borrowing my money, you will send me some interest payments, and then at the end of the borrowing period, you'll give me my money back. So that's what bonds and CDs are. Stock is ownership of a company. And we'll talk a little bit more about what that means. But it's really, really different. You know, if you've ever run a small business or worked for a small business or really worked for any business, owners are not entitled to anything, right? You hopefully have money left over at the end of the day, but you are not entitled to have money left over at the end of the day. So it's a really different relationship. The price of a stock is simply where a buyer and a seller agree to make a transaction. So during normal market conditions, there's kind of this generally same number of buyers, same number of sellers on each side of the transaction. Wherever there's a meeting of the minds, that's what the price of a stock is. So even during normal market conditions, that price is being reset throughout the trading day. Depending on supply and demand, you know, what sellers want to sell, what buyers want to buy. And that's what the stock market is telling us is, you know, from a minute to minute, second to second, really, you can see the price of stocks moving, which makes it fascinating and terrifying, right? Because when the stock market is out of whack, or when any market really is out of whack, when there are way more sellers than there are buyers, the price falls really far, really fast. As you're trying to find the price, if there's no buyer, the price falls until one person steps in and buys. Until that person steps in, the price is going to keep falling. And it goes the other way too. When you have huge rallies, the price is going to go up until someone sells. And so the stock market is doing that all day, every day. It's what the stock market is. It's showing us these change in prices. But it's on days where the price of a stock falls, there are more sellers than buyers. On days when the price of a stock goes up, there are more buyers than sellers. Like, it's actually like relatively simple. During March of 2020, there were way more sellers than buyers. So you had, I mean, extraordinary price changes from day to day. I mean, it really was remarkable. And I have some charts showing it. But if you were paying any attention, you saw the headlines or you saw it happening in real time. So it's, you know, there are times when all of the buyers step away and everyone becomes a seller. Remember that in the stock market, you know, we're here, we're on this call. I'm assuming that we're all just like normal investing people. You're investing in our 401ks or our IRAs or whatever. We are in the stock market with hedge funds who are unwinding their positions because all of their investors just called to ask for their money back. We're in the market with mutual funds who are selling their positions because someone just called to get all of their money back. We're in there with institutional funds. We're in there with quant funds that use algorithms. We are in the same market as everybody else. It's all the same market. So even if we don't want to sell, you know, if we're in it for 30 years, the price is changing because a lot of other people that don't have anything to do with us are sellers. And we're all in the price is reflecting all of that. So there was a lot of institutional selling in March, where that just means that people who had assets were being forced to sell them. And whenever you have forced selling, just imagine a fire sale or a bankruptcy or a going out of business sale where everything must go pennies on the dollar. That's really what it was like. And stock prices, this third bullet point here, the third caret, stock prices are always changing because investors' expectation about the future is always changing. So on top of that, or I guess the forced selling in March 2020 was precipitated by just this change as everybody realized that we were going to go into lockdown mode. because of coronavirus, that we were just going to stop everything and figure out how to keep people safe. So as soon as that changed and everyone's expectations changed, you saw the price reflect that very quickly.
Sarah, can I ask a question?
Sure.
This is Carrie.
Hey, Carrie.
Wow, I can't really hear myself. Anyway, I was wondering, so the reason all those companies had to sell is because the people that owned the stocks called and were like, we want our money back. So that's why they had to do a fire sale and sell it all at once. Is that right?
It's one component of it. I mean, into like all of the participants in the market, there are all sorts of like banking regulations and all sorts of things that feed into this. But if you can just imagine the effect it would have on prices if a whole bunch of participants, for whatever reason, needed or wanted cash right away. What would they do? They would just sell everything that they could find.
Right.
So some people just wanted the cash because they were trying to get safe. Some of those investors needed to come up with the cash, probably because they owed someone money and needed to pay them right this very second, or their firm would fail.
So really different goals than like an individual person saving for retirement.
Yes.
Okay.
I mean, completely different. I mean, on this call, the people I'm assuming are on this call, right? I don't want to, make, great assumptions, but I'm just assuming everyone here is a normal person, and not like on the show Billions or like Wolf of Wall Street, right? We're just like doing our thing in our retirement accounts. Again, we're in the same market as short-term traders, computer algorithms, hedge funds, private equity funds, banks, like all of these much larger entities. And they really do have the ability to move markets really, really quickly. And we're just kind of in it alongside, but we don't have the same motivations or the same needs necessarily.
That's super helpful. Thanks.
It's a really good question. Thank you. And for that reason, the last bit of the slide here is, for most investors, the stock market is only appropriate for long-term money for this exact reason. If you needed money in March and your only source of money was stocks, I mean, really bonds, the bond market did horrible too, you were in a really, really bad position. Like, you never, ever want to be a forced seller of anything, especially stocks, because the price can move so fast. So if you needed the money in March and the only place that you could get it was the stock market, that was a really tough position to be in. As investors, this is why, we talk about diversification, not having all of your eggs in one basket. It's why we talk about the emergency fund. And it's also, why we talk about kind of controlling your emotions so that you're not letting the price of something dictate your behavior. The stock market is only appropriate for long-term money, for money that you don't need for a long time. It's not for money that you need next month. Like, it's not for money you need really next year. I think we've talked about it a bunch in this group. Like, my thought is 5 years. Can you carve out 5 years worth of living expenses? Not necessarily in cash. Maybe part of it is in cash. Maybe some of it is in bonds. Maybe some of it is in some other more stable source, but not stocks. The plan is not, I'm just going to sell a little bit of my stock portfolio every month to pay the bills. Like, this is not individualized investing advice, but don't do that. Because then this is exactly what can happen, right? It can happen because it did happen. So that's the stock market really quickly. So if we keep going, this is like a super straightforward chart from Yahoo Finance showing US stocks versus US bonds from May 2007 to date, right? So it's 2020, so 13 years. So over the last 13 years, which is a pretty long time horizon, this is, starting kind of right before the crisis before this one, right? if you were kind of, Lori, going back to your point, like if you are on this purple line, which is bonds, your money is really pretty stable. Like there are ups and downs in the bond market. The price does change, but not nearly as much as stocks. So if you're on this purple line starting in 2007 and you're just being really conservative with your money, that feels amazing for a long time. As you are going sideways and the stock market, which is the blue line, and down here I'm using VTI, the ETF, the Vanguard Total Stock Market ETF, as a proxy for stocks, and the iShares Core Aggregate Bond ETF, AGG, is the proxy for bonds. But anyway, like the blue line is falling, the stock market is falling, the price of stocks is falling, and it's falling by 50-ish%. And so if you're in stocks, you are on paper losing money, while the people or the part of your portfolio that's in bonds is looking pretty good for a long time. We'll kind of learn like what drives the stock market, but eventually the stock market recovers and we see the blue line kind of crosses over this purpley line in, I don't know, mid 2013. So until then, from 2011 until 2013, if you were in the stock market, you were waiting for this growth to play out, right? But it took a long time for the stock market to come back. But then after that, the blue line continues to go up, right? It's not at all even close to a straight line, but the stock market continues to go up. The economy starts growing again. Companies are profitable again. Stocks increase in price. And since you started in 2007, if you had been just in US stocks, if you'd just been in VTI, this fund, you'd be up almost 86%. If you'd stayed in bonds that whole time, you'd be up almost 18% in price terms on both of those. So this kind of goes back to, Lori, what you asked, right? It's if you have enough to get on the purple line and to just go sideways, then there's not really, you don't have to take the risk and the volatility of the blue line, right? You can just go sideways, and in exchange, over long periods of time, you're going to get a lower rate of return.
Yeah.
Your money's going to grow, right?
I think this also talks to a question that Caitlin had about, what if you are one of those people that back in 2008, you just had your money in a bank versus somebody who had it in the market, and you would go through this loss, but ultimately it goes up over time. So Caitlin wanted to do like the very detailed calculation, which I don't know if we'll have time for today, but Caitlin, I think the general answer is that in the long term, meaning over, like this is over 12 years, you're better off.
Yeah, I mean,
This is Caitlin. Sorry.
Hi.
Sarah's showing my favorite slide. She knows this is my favorite slide. So I just wanted that comparison of the person who felt so smart and probably slept better in 2008 because they had their $100,000 in the bank account, but that person who wasn't sleeping well in 2008 because they had their $100,000 in the stock market. Fast forward to January of 2020, and the person who had sustained that huge loss, assuming they hadn't needed that money in the meantime, would have had a lot more than $100,000 in their bank account at that point. And someone with just the $100,000 in savings would have earned like 2% or something on their money in their savings account. So would essentially still have $100,000, but no more. Is that correct understanding?
right. I mean, so, at least according to the numbers here, the blue line, if you started with $100,000, now you'd have like 185, right? And a couple months ago, you would have had 200. You would have doubled your money over that period of time. If you had your 100,000 in bonds that whole time, you would have something like $117,000 or $120,000, right? So it ends up being a difference of tens of thousands of dollars over that 13-year time horizon. And that's including, it means like for that extra money that you ended up with, you had to gut through, now two pretty serious crashes, right? And if you're going forward in the stock market, you're going to have to gut through some more, right? It's just the nature of what the stock market is and what it does. But the reason that we do it is because we need or want to end up with more dollars eventually, right? But the eventually, is part of the rub of being a part of it. Did that answer your question, Caitlin?
Yes. Yes. Can you hear me?
Yes.
Yes.
Thank you. And we can certainly come back to all these slides at question and answer too. But I'm going to keep going. This is just one of the slides that shows like how painful it can be to be in the stock market. But again, like the reason that we do it over time, it's because you need or want to end up with more money. Look at this next chart. Here's one. We'll shorten the time horizon a little bit and just go back to May 2009, which was just a little bit after the all-time lows of 2009, which were in March of 2009. So here, so now we're on an 11-year time horizon. If you had invested in May 2009, so remember from May 2007, that was like before the crash, during the housing-related market crash. By May 2009, 2 years later, we were in it. Like we were far into this really serious stock market decline. If you had invested then, after the crash, and held your money until today, over those 11 years, you would be up over 206%. And your bonds would be up almost 15. This is like a very important chart, right? This one is, I got through the crash and eventually recover. This one, the May 2009 one, is for the money that if you can or want to or choose to, the potential for the money you put in during a crash. This is like what happened for people who, 2 years, a 2-year stock market recession crash, the last financial crisis. People who were still investing, even if just a little bit, even a little bit that went into your 401k or a little bit extra that went into your IRAs and went into the stock market 11 years ago, has now grown 206% versus the keep the play it safe money, which has, at least according to this chart, for most purposes gone sideways and not grown very much at all. So this is kind of the post. This is the chart of the why would I do this now, right? This was the chart that I'd show over and over again for like, okay, why do we do this? Theoretically, we're investing for the long run. Like, okay, be prepared for the crashes, be prepared for the long upswing. This is just how the stock market works. But this one is now super relevant. Like, why would you choose to do this now after the crash or during the next crash? It's because some of your money could grow this much, 206%, instead of just the 85% over here from kind of a peak time or a good time to good time, up 85%. Bad time, well, now to another bad time, right? Bad time to good time, or bad time to the next bad time, up 206%. I hope that kind of makes sense. This is a new chart just for this meeting. Okay, if we keep going, if we go back to the time value of money calculations, like where do the 5% numbers for a more conservative portfolio and the 10% numbers for a more aggressive portfolio come from? This is a chart showing risk versus return for different asset classes that you could theoretically invest in. So this is over the time period 1994 through 2018. So this actually doesn't include last year or the first part of this year, but it's still applicable to what I'm about to say. So over here in the bottom kind of left-hand quadrant, we have cash and bonds. Well, I'll explain the chart a little bit here. Okay, so every time, this gets me every time. The x-axis, is that the across axis? Lori, can you give me a thumbs up on that? You're an engineer, right? Okay. Okay, the x-axis, the across axis, standard deviation of annual returns. In investing, this is often the measure that we use to calculate risk. And it's the risk that the price of your asset is going to go up and down. So the higher the standard deviation, the more variable the price is of your asset at any given point in time. On the y-axis, this is compound annual return. This is also expressed as a percentage. This is the R that we're looking for, the rate of return that we're talking about, our compound annual return. So there's a relationship here between risk on the x-axis and return on the y-axis. So if we have aggregate US bonds over here, you can see we're out a little bit on the risk spectrum. We're taking a little bit of risk, the risk that people don't pay us back. And over these 25-ish years, we've gotten a little bit north of a 5% rate of return for taking that risk, lending people money in the bond market. Now, if we go further to the right and we are increasing our risk or the volatility or the standard deviation of our annual returns, and we go up to the upper right-hand quadrant, this is where our risky investments are hanging out, or some of them. So here we have large US stocks. This diamond is the S&P 500. So you can see that in the footnotes, like what the diamonds, like where the information comes from on the diamonds. So large US stocks is the S&P 500. Small US stocks, so smaller companies over this time horizon have been as risky as larger companies, but from 1994 to 2018, they actually haven't returned as much as larger US stocks. Kind of interesting. Over here, this diamond that says real estate, make a super special note in red pen, bold letters. This is commercial real estate. This is not your house, even in Austin, you Austin people. High risk, high return, long periods of time. But the commercial real estate market, like the stock market, is kind of boom and busty. So it's quite risky. If you're investing in commercial real estate right now, you are feeling this pretty hard, right? Are your tenants going to come back? Are they going to renew their lease? Are they going to stiff you on rent payments? Who knows, right? What's your occupancy going to be like? But these high risk, high return asset classes. Down here, we have non-US stocks, so international stocks, and this is from the perspective of a US investor. We go overseas and invest in stocks. From 1994 to 2018, relatively high risk, high standard deviation, but over that period of time, we were not compensated with higher rates of return. This is something that maybe past performance is indicative of future results could be applicable to. Are there parts of the world where we expect their stock market to do better than US stocks? Maybe. It's also probably outside the scope of this call. Oh, goodness. And then down here we have commodities, right? Raw materials. So those of us in Texas, oil and gas, also things like timber, soybeans, things, the raw materials that get used up, right? So the commodity space, super risky, right? Very high standard deviation. And over this period of time, 1994 to 2018, look how low your compound annual return was. Commodities market is very specialized. I know that I've gotten a lot of calls and a lot of questions about investing in oil right now. Like, this is the commodities diamond over long periods of time. If you venture into commodities, just know that it's a very specialized space, and it's not like any of these other asset classes. So do your due diligence, especially in oil and gas. The way that you buy oil is through futures contracts or these ETFs that don't work very well. Understand them before you buy them. That is probably about as much time as I'm going to spend on that, but be careful. But this is where that 10% number comes from. Large US stocks, that diamond is sitting just above that 10% line from 1994 to 2018. So that 10% number that we're assuming over very long periods of time includes the dot-com bubble, the real estate bubble, and stock market crash, financial crisis. It doesn't include the most recent one, but I'll get you updated numbers as soon as I can. But it includes those two prior crashes. So that 10% number accounts for the crashes. Most people think that to get the 10%, you need to avoid the crashes, but you don't. It accounts for it. Excuse me. And then over here, if you're going to play it safer, you're going to end up with a lower rate of return. It's just the way finance works. You shouldn't expect to get a higher rate of return for not taking risk. Are there any questions on that? All right, let's keep going. Warren Buffett. Warren Buffett, I think, is talking right now at his annual conference. So if you're into Buffett, and we'll be getting lots of Buffett news today and tomorrow, because speaking at the Berkshire Hathaway conference now. And Warren Buffett says you shouldn't own common stocks if 50% decrease in their value in a short period of time would cause you acute distress. So even Buffett knows that when we're in the stock market trying to achieve those higher rates of return, these types of crashes, they're part of the plan. They are definitely going to happen. And they're not going to stop happening in the future. There's never going to be a point in time where the market is solved and you just get a 10% return and it goes straight up without any crashes. So it's all about adjusting your expectations going forward or getting comfortable with that. Or even if you're uncomfortable, getting comfortable with being uncomfortable. And this kind of continues along that point. So there's a lot going on in this chart. The black line is the price of the S&P 500. So the price of a basket of well-known US stocks. It's that number that's quoted in the financial media every day. The S&P closed at 2,400, or the S&P was up 50 points today. So that's the black line that we're talking about here. This red line is, I think this is a cool chart. So this red line is the S&P 500 index daily percent change. So how much did the price of the stock market change in one day? And this just goes back to 2014, and you can see most of the time we're kind of in this 1-ish% area. You know, the market goes up 1%, down 1%, something like that. Then we have these spikes. We're like, oh, we'll have a big move in the market one day. Like one day, the stock market, it's usually falls, 3.9%, or falls 3.6% in one day, or falls at the end of 2018, it fell by 4% or went up by 5%. Over here on the right-hand side, this is March of 2020. We had a day where the stock market fell 12% in one day. It was horrible, right? And it was super scary and fascinating and unprecedented. Maybe not unprecedented. The stock market fell by 20% in one day in 1987. But we hadn't seen these types of moves for a really long time, right? So this daily volatility in 2020 has been much more than what we as investors have been used to, especially since the end of the last bear market. But like the basic relationship is investors who stay in the stock market over the long run, you earn that 10%, that higher rate of return than your cash or your bonds. You earn that precisely because of the price volatility. Like imagine the people who are jumping out and the people who are jumping in are the ones who will get the increase in price when the market turns around. Now, we don't have any control over when that happens, but you're not going to get part of the rebound if you're not in the stock market. So I think of it like the stock market flushes people out, right? It flushes people out who either run out of money, have something like a margin call where you borrowed money to invest in stocks and then the stocks fall and you still owe the loan back. Hedge funds close their shop, or firms go bankrupt. People pull out, certainly, but part of the reason that you get the higher rates of return is because of the volatility. Like those two things, it's like a hand and a glove. Like they are together. They are related to each other. So I just thought this chart was cool because it shows this really, just kind of almost off the charts volatility from last month, which I guess was 2 months ago now. We're in May, from March, right? So I think it's a really interesting chart. If we keep going, can you predict where the market is heading? I love this chart because it shows, going back to 1957, just kind of all of the bad things that have happened, right? Bad things just always happened. They will continue to happen. Got a lot of crises on this chart. The black line, again, is the S&P 500, the price of the S&P 500. Here in 1987, here you can see where the stock market fell 20% in a day. And then up here, we have our March of 2020, our coronavirus crash here, right? When you're in it and you're so focused on the day-to-day, you forget to zoom out and look at what a stock market price chart looks like over long periods of time. Falling 12% in one day is a lot. I do not want to discount that. It's a lot. And falling 34% in less than a month is a lot. When we zoom out and look at the trend of the stock market over long periods of time, you can put it into context and start thinking, okay, well, what's going to happen in the long-term future? And just again, going back to, if you're waiting for things to be safer, you're not going to find a time that feels safer. Even like as part of this group, some of you were there, and we talked about January and February when the stock market was at all-time highs and people were still worried, right, about what was going to happen going forward. There's never a point in time where people are really, really comfortable about being in the stock market, because we're always looking forward to what's the next thing that's going to happen. Like, oh my gosh, it's gone up so much. When is it going to fall? Oh my gosh, it's fallen by so much. When is it going to fall more? Right? Like there's kind of this inherent pessimism, but you have to zoom out to look at the reason that we're in the market is for this long-term upward trend. So can we kind of get used to being, again, it's being comfortable with being uncomfortable in the market. Like you're always going to have a reason not to invest in stocks. You will always be able to come up with something. That's just the nature of what we're doing here. So to talk a little bit more specifically about kind of where we go from here, I want to touch on really quickly the relationship between price and earnings. Again, I know a bunch of you have heard me talk about this before, but I think now more than ever, it's really, really important to come back to. So this is just a highly, highly stylized version of an income statement. An income statement is also known as a profit and loss statement. It's one of the statements that a publicly traded company that's available for us to invest in, these publicly traded companies need to publish their financial statements every quarter. We're right in the middle of earnings season where companies are putting out their profit and loss statements, AKA their income statements. And they're generally organized like this. At the top, we have revenue, also known as sales. So that's like you walk in, you order an iPhone from the Apple website. They take your $1,000, they send you the iPhone, and that $1,000 is revenue to Apple. So that's also called the top line. So revenue and sales is at the top. Next, the company has to pay for the cost of making whatever they're making. So they have to pay their suppliers. They have a cost of raw materials. So that money goes out the door from the company to the suppliers. Next, the company has to pay all the people that work for the company. In addition to things like rent and software, whatever the costs of running the business are, those are called operating expenses. So those need to get paid too. Next, if the company's borrowed any money, they need to pay the interest on the money they borrowed. So that comes out here. Now, if there's any money left over, you have to send a check to the government for taxes. So that part comes out. And then after all of these other people, all these other stakeholders get paid, you have something called earnings left over, maybe. Earnings are also known as profits, net earnings, net income. It's also called the bottom line because it's at the bottom of the income statement. And this is the number that the owners of the company care about. Because if we're shareholders or stockholders, we're owners of the company. So we want to own companies that generate profits. If they don't generate profits right this very second, we want to have some expectation that they will generate profits in the future. So this earnings number is really, really important to owners of a company. And right now, like I mentioned before, we're in the middle of earnings season. Amazon just reported earnings last week. I think Microsoft reported earnings last week. A bunch more companies are going to report earnings next week, starting Monday. There's an earnings calendar. You can see who the companies are. But this earnings number is really, really important. And so on this next slide, I love this chart. I apologize for those of you who have seen this chart probably like 20 times, but I'm just going to keep showing it because I love it. This shows this relationship. The black line is the price of the S&P 500. So the price of the stocks of those 500 companies that are in this S&P 500 basket. And the red line are the earnings or the profits that those 500 companies actually generated. We know what the black line number is because we report it every day. It's just a combination of the price of those 500 stocks. And we know what the earnings are because the companies report them to us. And we can add them up and make a red line. So we can see that most of the time, the black line and the red line are pretty closely related. Earnings over long periods of time, they influence the price of stocks. I mean, they're the key, they don't even just influence it, they're the key underpinning of the price of stocks. They drive the price of stocks over long periods of time. Over short periods of time, I mean, who knows? It's like sentiment or technical indicators or whatever. But over long periods of time, your expectation about where the red line is going should drive your expectation about where the black line is going. So expectation of earnings drives your expectation of price. Back here, we have the dot-com bubble where the earnings of especially internet companies didn't go up as fast as their price did. So this is what a bubble looks like. It's when the price of something is way too high relative to the reason that you own that asset. So for stocks, it's earnings. For real estate, it's rents. The second mountain here, we have the black line going up from 2003 to 2007-ish. Earnings are going up, prices going up. Then we had a bubble in real estate that time. It's dragged down bank earnings. The red line fell, the black line fell. We had a stock market crash. But eventually the red line stops falling. Companies start generating profits again, start growing their profits over time. The black line eventually catches up to the increase in earnings, and that gets us to where we are today, right? Where we have this black line went way up with the expectation that everything was going to be fine in 2020 and beyond, and then a huge price decline as everyone realized it's not going to be fine. There is going to be a major impact on earnings, on companies' abilities to generate profits if we're all in our houses. So this is what drove this massive shift in sentiment. Everyone realized that our expectations for profits for 2020 are way overinflated based on this new information that we have now and this reality that we're living. So what we're seeing here with the red boxes are consensus earnings, right? So you have a bunch of people who are paid to estimate what earnings will be. As of now, their estimate is that in 2020, it's going to be this red box. And then in 2021, next year, earnings are going to be the second red box. If that's the case, then that explains this relief rally. That's really been one of the questions that I've gotten, in April was, why is the stock market going up? Things are terrible. It's because the stock market, remember, finance and investing is forward-looking. So the stock market will often just jump over the present and even jump over the near future into maybe like 6 months out, 12 months out. Even now, if you listen to the financial news, you'll hear people talking about 2021 already. It's only May of 2020, but it's almost like May of 2020. The numbers that are coming in now are almost irrelevant. Everyone knows they're going to be bad. So people are already looking forward to what they think will happen in the future. So this ties back to the topic of today, where do we go from here, right? First of all, no one knows. Second of all, everybody's trying to figure that out, right? What are profits going to look like through the rest of 2020 and through 2021 and beyond. You can do this calculation in the aggregate for here, the S&P 500 in the aggregate. You can also do something similar to this for an individual company. So when you think about it like that, you can think of companies whose profits are going to be either non-existent or have huge losses this year. But you can also probably think of companies that are going to have huge profits this year. Some businesses are going to grow and get much bigger coming out of this crisis, and some companies are going to die. They're just not going to make it. They're going to cease to exist. The stock market, the S&P 500 is kind of a mix of those, but it's really the question that investors are asking is, okay, in 2020 and 2021, what do we expect profits to be? And we're just starting to get information from companies now during earnings season, because companies will report what happened last quarter, which no one cares about. But even more important, they're sometimes giving guidance as to what they expect to happen in the future based on what they're seeing in their business now. Spent a lot of time on this chart. Sorry about that. I'm going to keep going though, and we can definitely come back to this. But before we're going to continue along this track for just a second. Because if you were I'm looking at this chart, and I got this, so Fritz Meyer, one of my very favorite economists, puts out this chart and updates it every month. This was the chart from April. If I'm looking at this box, I'm looking at this for 2020 and thinking, man, people really don't think that profits are going to be much lower than they were last year. That's kind of weird, right? That doesn't seem in line with reality or common sense or anything that you would expect. So luckily Fritz went through here and kind of adjusted these earnings estimates. So up here with these carrots, this is just the earnings part of that chart from before. But he went through and said, okay, consensus earnings, IBES, projects a 4% decline in earnings for all of 2020. But then you have some of these other people or companies putting out their own forecasts, right? S&P thinks that earnings will fall 7%. FactSet thinks they'll fall 9%. Bank of America thinks they'll fall 29%. And then we have Goldman Sachs, who is predicting that profits decline 33%, while cautioning that in a more painful slowdown, the decline could be 57%. No, I'm talking about earnings right now. I'm not talking about price. I'm talking about earnings. But now we can adjust our expectations to account for this wide range of possibilities over the next couple of years. So if we bring those boxes way down, so over here on the left-hand side, you can see this is on the $130 in earnings for 2020 line for 2020. And then 2021, so if we look forward to next year, the assumptions with these boxes is this year's bad. Next year is maybe about the same as last year was. Does that make sense? So kind of earnings go bad and then they bounce, then we kind of get back to where we started from last year by next year. And we can definitely come back to this if you have questions. But when we layer that onto our price chart here now and put in our more realistic expectations for earnings, now our chart looks a little bit different than the first one. So remember, the black line here is here on this chart. The black line is the price of the S&P 500. And these red boxes are expectations for earnings. So now it kind of starts looking that, okay, for 2020 and even into 2021, maybe the rally is justified. Okay, if we're already going to look into 2021, the black line has bounced up expecting things to be better next year. So if that's the case, and if that happens, then the price today is probably about the price it should be over the next 12 months, 6 to 12 months. That would be the explanation for this recent rally in April. It's like, okay, we're already looking forward to 2021. We expect profits. We know profits will be bad this year, but we're just going to kind of jump over that and focus on next year instead. And that would explain this relief rally. If this red line for 2021, or this red box, if expectations about profits going forward go down, you would expect the black line to move accordingly. So the where do we go from here part for 2020 and 2021 is probably like as clear as mud, right? If I'm looking at this, it seems like, okay, if we're, companies are resilient. Companies figure out how to make money in lots of different environments. You don't need perfection for companies to learn how to make money. They'll figure it out, and they're figuring it out really, really quickly. And also, some of the most profitable companies in the world thrive in this environment. Like, they are going to only make more money in the future based on all the trends that now are going to pop out of this crisis. Working from home, e-commerce, artificial intelligence, all of that stuff. But some companies are not going to make it, right? Like maybe quite a few companies aren't going to make it. But, over the short term, there's a lot of room here. It doesn't look like we're going back to all-time highs, but do we need to go back to the lows of March either? I don't know. It's a pretty wide range of outcomes over the next year or two, somewhere between 2,200 and 3,400 on the S&P. I mean, that's a really wide range of outcomes that we are all just guessing about in the short term. Which is why I like to take it back to stocks for the long run. Another Warren Buffettism. Someone is sitting in the shade today because someone planted a tree a long time ago. Like, whenever we're talking about the stock market, and I know this has been the case, over the many times that I've talked about it here, we talk about the short term, but then we focus on the long term, right? Because we're trying to get someplace more distant than 6 months or 12 months or even 2 years from now. We're trying to get somewhere farther out than that. And so if we can start thinking about what the world might look like in 2025, that's only 5 years from now. Do you think that companies will have figured out solutions to some of these problems? Probably. Are some of these companies going to make a ton of money from solving those problems? Yes. And will that be enough to drive the stock market higher than it is today? Not a guarantee, but probably. I mean, there's a pretty good case to be made. I mean, you could also turn around and make the case for things completely crumbling and turning into dust and, long-term stagnation. If, you just have to think of it, though, through the lens of earnings and profits. And I tend to think that companies are going to make a lot of money from this eventually, maybe not in the short term, but in the long term. And that, as an economy, especially if we're just focusing on the US, that we're going to figure this out. I might be kind of Pollyanna if I'm thinking that way, but that's just what I think. So I think if you zoom out to 2025 and beyond, you can start really making a pretty strong case for, if you're not in the market yet, dabbling. If you are in the market, just hang out. Stay in there. Don't try to jump in and out. Because in the short term, going back to this, if you're trying to jump in and out, the range of outcomes is so wide, it seems to me to be impossible to figure out exactly which way we're going in the next 6 or 12 months. But again, over 5 years, 10 years, 20 years, I have more confidence in the direction of where the market goes over those time horizons. Investing takes patience and discipline. What I wanted to show here was, this is showing, there's an investor that I know, and she's a longtime investor. She's a completely normal person. She is, every time there's a market decline, she calls and is nervous. So she's like kind of She's not like nerves of steel. She's a totally, again, normal person, but she puts money into her accounts. The money is the gray line. So that's her net deposit into her accounts. And this is roughly a 5.5 to 6 year chart showing the growth. The growth is the blue line, the growth of her investments over time. So you can see that in the short term, when she first started, there were times when the blue line was above her original investment, but there were times when the value of it fell below her original investment, and that'd be really painful. And that's just how the market might go when you are first starting to invest. But as you build up time and keep your investments growing, I call this like the alligator jaws. You want to get to a point that the value of your investments is pulling away from the underlying amount that you originally invested. Does that make sense? And so I think this person is a totally normal person, like most of the people on this call, who are just like trying to do the best they can with the money that they have and keeping a long-term focus. Every time the market falls, we talk, we come back to what her goals are, which are to grow her money over the next 20 to 25 years, and she stays in. And sometimes she even throws more money in it. So it's not easy, but it requires patience and discipline and a little bit of faith that the market is in some form or fashion going to work in the future like it has in the past. So I just kind of wanted to put this in here too. I know that this environment is really difficult for a lot of people. But I know that beginners and people who aren't professionals can do it because I see it every day.
So Sara,
questions? Yeah.
Your question section.
Yeah.
I was going to bring up some questions that people were having. I'm trying to group them together, but basically some people are wondering, is now the time to get in and buy? Is it going to dip down again? And that's when they should buy, or is now the wrong time to get in because it's just going to fail? Basically, what's your view for when to get in, and is there something about the earnings season that might help people get in? Just questions in general about that. So here's people ready to get in the market.
Yeah.
And wanting to know, is like now the right time?
Yeah. Oh my gosh, that's the $1 million question, right? Is now the right time? I think it depends. I know that it depends on each person's on your risk tolerance, but risk tolerance is just kind of like a word that we use for like how nervous are you? How often are you going to check the accounts? And if you invest your money today and the market falls, what are you going to do? Right? So there are some people who are just like, yeah, this seems as good a time as any. I don't really want to think about this. I have a job. I'm homeschooling my kids. Like, I know I should be investing. I'm ready to start. And I really don't want to think about it for the next 5 or 10 or 20 years. If that's where you are, then this is going to be a good time to invest over a long period of time, right? If kind of on the other end of the spectrum, it would make you feel really, really bad if the market fell further from here, then a good strategy to use is to take whatever amount you're investing and chop it up into little chunks and invest it a little bit at a time, right? So we call it dollar cost averaging. You're naturally doing that if you're investing in a 401k, right? You're investing part of your paycheck every pay period, but you can do it in your regular life too, right? If it's like I have $25,000 in my checking account, I know I should be investing it. Now seems like a time that would be maybe favorable. You could take that $25,000, chop it into 5 chunks of $5,000 and put $5,000 in each week for the next 5 weeks, or whatever the amount is and whatever the time period is. That way, if the market falls, then hopefully you feel good because some part of your money went in while it was falling. But if the market goes up, you would have gotten some portion of your money in today. there is no way to know where the market goes from here in the short term. I know that's like an anticlimactic ending to this presentation. There's just no way to know. And because this crisis is so news driven, it makes it even harder, because news on treatments drives the stock market at this point, right? If someone announces really good results from a treatment that make COVID less deadly, the markets are going to react to that, because it'll mean that people will be more comfortable to go out than they do now, right? So like part of the underlying reason for this crisis makes it trickier. And also, you know, they call us a whipsaw, right? People have gotten whipsawed over the last 2 months. Market fell really fast, market bounced back really fast. But now it's been basically 2 months since we started this exercise. There are a lot of people who are in cash waiting for the next dip. And if there are that many people waiting for the next dip, there's a pretty decent chance that the dip isn't as dramatic as it was in March, when people weren't really preparing for it, right? It's like as more time goes on, if things don't get really a ton worse, then you might be waiting for a dip that never comes or doesn't come in the magnitude that you wish it did. If you're now going back and saying, man, I wish I would have put all my money in when the market was at 2,200 and now it's at 2,800, you can kind of arbitrarily set that 2,200 mark at the point at which you jump back in, but just know that there's a pretty decent chance the market doesn't go back to 2,200. And it either goes sideways or kind of up and down between, I don't know, 25 and 28. So unfortunately the answer is I don't know. I think you really have to ask yourself what you will do after you invest. What if the market continues to fall? What the answer is, I'm going to jump out. This is going to be really, really tricky for you just over the long run. If the answer is like, oh, I'd feel kind of bad, but I just leave it in for the long run, and okay, that's pretty good. If the answer is I'm going to put all my money in the market and then forget I ever did it and come back in 30 years and hopefully have $175,000, then you should get it now. So I know that's a non-answer, but it really kind of depends on your personality. Oh, you're muted, Lori. Can you unmute yourself?
Sorry. If you're planning on retiring, say in the next 8 years, you know, the market's down right now, so all of your investments are down. What should be your goals right now? Should you be trying to get in the market, even though you know you're going to want to pull out maybe in 8 years? What do you think you should be doing right now? What advice would you have?
Not advice.
Yes, not advice. Hypothetical advice.
Hypothetical advice. It's an 8-year time horizon.
8 years. And whoever put that question out, if you want to give some more details.
Yeah, hi Sarah. Can you hear me? This is Sage.
Yes. Hi.
Oh, it's always good to see you again. But yeah, let's say if you are thinking about retiring in 8 years, and you're thinking, okay, I have some cash, I can put it in with the apprehension, like you said, that it might go down, even more so. But I don't want to get caught up in 8-10 years where I guess I don't want to lose everything either. Yeah. So it's just a nervous stick where I just wanted your opinion of when lot of times I hear people say long term, short term. I understand short term is 1 year, but do you qualify long term as more than 5 years typically in stock market?
I prefer it to be 10 years, but Sage, one of the things here is it's an 8-year time horizon to maybe retiring, right? But most people expect to have many years or many decades in retirement, when you're still going to need part of your portfolio to grow in order, and this is where, like, over the long run, part of the reason for stocks, and we didn't cover this, part of the reason for stocks is they're an amazing inflation hedge. That means that they adjust for inflation and allow you to grow wealth over long periods of time. So most people going into retirement don't go to 100% cash, right? Like you still have some blend, unless you're one of those people that has enough money to take no risk, right? Most of us will go into retirement with some portion of our portfolio in stocks for the long run. I mean, if you retire at 60 and you expect to live to age 95, some portion of your portfolio is appropriate to be in the stock market so that you can pay for the stuff in your 70s and 80s and 90s. It'll be way more expensive then. So I think, so what I'm getting to here is, as these transitional stages of retirement where you go from earning an income to drawing money out of accounts is really tricky. Like, what percentage is in cash? What percentage is in bonds? But if you look at your overall portfolio, if you're working under the assumption that you'll have many years left on this earth, there's still a portion of your portfolio, even in retirement, going into retirement, through retirement, well into retirement, that will have stocks as part of it in order to keep growing through that long retirement stage. So I think that it would be, the exercise for you would be, is your portfolio now close to what you expect your portfolio to look like through your retirement, through the end of your life? Or does it need to have more growth? Or is it large enough where you don't need the additional growth from stocks? And
so I think that was a great answer. You're right. It helps me understand of how you're going to use it even beyond your retirement, just like you said. But let's say if you need to grow it in order to get to the retirement age, but the markets are very uncertain right now, at that point, wouldn't that be riskier to go in it?
That's a really good question. I will give you my counterintuitive answer to that question. Anytime you're buying an asset, it's less risky to buy it for less money.
That's true.
If housing prices in Austin fell by 20%, what would everyone here do? Would you sell your house? No, that's insane, right?
Makes sense, yeah.
Stocks are an asset. Real estate is an asset. Stocks are the only asset where people sell when prices go down instead of buying when prices go down. So it's like, it's just this whole shift in the mindset. When prices go down, if over the long run you expect prices to go up, when prices go down, it's like the idea of like buying on sale, right? That's the easiest one to think about, but it's also reducing your risk. Yes, stocks could fall more. They could, and get even lower in price in the short term, and they can go sideways or down for a long period of time. So it's not taking away the risk. But when prices go down and you're buying something, you're putting the odds in your favor even more that you will eventually make money from this investment. There are a lot of people that bought real estate at the top of the real estate bubble at high prices when everything seemed safe and cool and like we should definitely do this. There are a lot of housing prices that have gone sideways or maybe not recovered over this entire time period, right? Like, again, it's that idea of lower prices. This is like a Warren Buffettism too. Buying at a lower price is less risky than buying at a higher price. And this is one of those times the price is lower than it's been, in quite a while. Could it go lower? Yes. So maybe that's a dollar cost averaging solution. Like you put some in now, or some in now, some in a little bit later, a little bit later than that. But I think it's like developing the habit, again, developing the habit of getting comfortable with the uncertainty because it will never go away. Like there will never, ever, ever, ever be a time when everybody's like, now's the time to invest in the stock market. Usually it's like prices are falling and people are freaking out and assuming it's going to go lower until it goes to zero. And I'm also talking about investing like in the S&P 500, like a basket of companies, not in one company. One company can go bankrupt and can go to zero, like Enron, right? The S&P 500, a basket of companies, just the broad stock market, or any, a mutual fund that has a bunch of different companies. If like the basic laws and structure of our civilization stay intact for the next 30 years, then all those companies won't go to zero. So kind of that idea of like losing all my money, that's another one that it's really easy to go to. Like, okay, it's already fallen by 30%. What if it falls to zero? Just make sure that you're not investing in one company. Make sure you're investing in a bunch of companies. And do you expect all of those companies to go to zero? Hopefully not, right? I don't think that's anyone's like even worst case scenario. But it's easy to go there mentally. So I love that question.
Thank you so much.
Yeah, thanks.
Sara, some people are wondering about what some of the things that the government's going to do, how they're going to impact the market. And of course, nobody knows, but some of the programs with the Fed where they're going to pump money into the economy, is that, obviously that will affect the market somehow, but do you have any thoughts on how that's going to work? And would it mask something in the market so that you can't really tell the real value of things?
Yeah, man, that's a really, really good question. Okay, so my personal thoughts, in March, when sellers were selling a lot of stuff really fast with no concern for prices of those assets. And I'm talking about stocks, I'm talking about bonds, pretty much everything except for US Treasuries. The Federal Reserve stepped in, first of all, because it's not good for anyone for markets to be disorderly. And second of all, I really believe the Federal Reserve and Congress also are learning lessons from the last financial crisis, which is that it is not good for anyone. It's not good for financial markets, and it's not good for the citizens of our country for people to have mass unemployment, for there to be mass unemployment, and for there to be a recession, and for people to suffer when a pretty easy solution, and one that could have been used in the last crisis and wasn't, is to just give people money. And it sounds like ridiculous, right? Like, but how do you keep people from falling into poverty? Like, you send them checks, right? How do you keep companies from going bankrupt in a crisis like this? You send them money, or you send them money and ask them not to lay people off. You send the company money and then you ask them to keep people employed until we can get to some other side of this. So I think the assumption of all of these programs is that they're a short-term stopgap in order to get to some resolution to the medical issue of COVID, right? Which, I haven't spoken to at all. I have no, qualifications to speak to. But it's like to get to the other side where you can get the economy moving again, whatever that looks like. I think that if humanity finds a way to solve the medical issues that are popping up, then the stimulus that has been put into the system is probably fine and absorbable. The US is very big, it's very powerful, it's very rich. And there will certainly be something that shakes out, right? If it goes on for a long period of time, it's going to be a lot more difficult. And it could lead to inflation over time. But it looks like the Federal Reserve and Congress they're focused on the short term, right? They're focused on keeping money in people's pockets and keeping businesses employed. And that probably is messing with the price of, especially like a company like, a company like Boeing, right? Like what's Boeing worth? It's really tricky to say right now, but, and that's probably being masked by kind of the government intervention there for that company. But I think that more than anything, the Federal Reserve and Congress they're trying to stop actual people from getting hurt, and that probably benefits people who own financial assets, like investors. So I don't know if that really answered the question. There will certainly be ramifications. I don't think anyone knows what they are, is probably the short answer. Oh, hold on. Can you unmute yourself again?
Sorry. Another question's related to the circuit breakers. So when the stock market falls really fast, the circuit breakers kick in and basically put everything on hold. I think it's for like 10 minutes.
Yeah, 15.
15 minutes. And then everything continues on. Are there any ramifications for that, for how that's affecting the market? I wonder if it's something to do with like all the robo trading, because there's so many companies now that are automatically kicking in sell orders. But what's your idea about those?
Yeah, hold on. I'm gonna can I pause share?
Hey, hello.
Hi. Oh, yes. Was that more on the circuit breaker question?
Hello.
Hello?
I can hear you.
Oh, okay. This is Sue, and this is my first time joining this meeting. I just wondering, do you have a calendar about what's the next meeting will be, and what's the content? Like, do you talking about the stock sectors, or are you just keep going on those basic general questions about the current situation?
Yeah, I'll just answer that really quickly, and then we'll go back to the circuit breaker question. The next topic is investing for beginners. It's on May 23rd at 2:30, and so you can find it on the Meetup group or the Facebook group. And it'll be kind of like what it said, investing for beginners. How do people get started who are just starting in investing?
Yeah, and in general, our meetups have a bunch of different topics, and if there's some topic that you're interested in, put a message on the Facebook group or the Meetup group.
Hold on. So Gwen has asked me to. Can you guys see me now, or do you still just see my screen?
We see your screen still in the main area, and you, well, on my screen, you're a little box.
I'm a little box. Sorry, I'm trying to bring up so I can see all of you, and I can't. I'm sorry, I can't figure out how to do it.
You'll probably have to click
there
on
it
the
is.
box.
Boom.
There.
Yes.
Hey, Sarah.
Hi, everybody.
Can you hear me, Sarah?
Yeah, hold on. Can I go back to the circuit breaker question? Was yours the circuit breaker question?
Yeah, this is Sandy. Hey, I was curious. I was curious what your reaction was, because the circuit breakers, not only did they trip, but there was like 3 in one day, and then the market closed early from what I remember. It was pretty insane. I was just wondering what was it like in Sarah's head that day that happened?
Yeah, I mean, so there were a series of days where circuit breakers hit. It actually became a running theme in our house. Like my husband, who's not a stock market person, would check the futures, the stock market futures at like midnight and let me know if he thought the circuit breaker would trip at 8:30 the next morning. And so just the way they have it set up structurally is like you have a stock market where you have a bunch of participants. Again, going back to this idea, you don't want markets to be disorderly. So they have these circuit breakers. It actually came out of 1987 when we had that 20% decline in one day, that if the stock market falls by something like 7%, maybe it's 5%, the market will close for 15 minutes and just let everybody like think about what's happening and like get their wits about them. And then if the market reopens and falls by another 7%, maybe that's it. The circuit breaker is triggered again. There's another 15 minutes. And if it now I wish I knew what the market will close for the day. They'll just be like, come back tomorrow. We're not doing this anymore. It's really a way to give people a chance to just like get their wits about themselves, like stop panic selling. I don't know if it was super helpful. Some people were talking about closing the markets altogether, like for a week or like a long weekend. I think that would have been a million times worse because it signals to people that something is really, really, really bad, right? So you like don't want to spook people by doing something that is completely out of the ordinary to tell, in order to avoid something bad happening. So I don't know, it was fascinating to watch it happen. And I think that that's where, like, going back to like, we're all in the market together. We're in the market with algorithms that are set up to sell when things go down. You can see this, like, you can see these triggering effects. The market goes down, so an algorithm says sell, which makes the market go down more, which tells the algorithm to sell, right? It feels very disorderly. And the markets are trying to prevent that, but there's only so much you can do. So it was weird. I don't know. Was anyone else like fascinated, like watching the market happen? This is obviously what I do for a living. So I was just sitting in here, just, listening and watching to what was happening. I don't know. Like, I don't know. I don't know if it's like a sickness that I have, like this fascination with it, that, I just thought it was really interesting. Right. And, scary in like a horror movie type of way, but I thought it was really, I thought it was really interesting. So I almost felt like I was not happy. Like I was interested to be a part of it. I'll just keep saying the word interesting instead of happy, because it wasn't a happy occasion, but it was fascinating.
It was fascinating as in horror movie, just like you said.
Right.
Now you're trying to close your eyes, then open it again, and close your eyes and open it again. Yes. And then you get sick, and then you throw up a little, and then you come back and you're like, I can't help watch this.
I know. There are people that like horror movies though, right? A lot of people. That's why.
I was focused more on the human behavior. I'm fascinated at how us humans work. I mean, because I work for a company and we have Slack channels, and there's a Slack channel for finance, and it's mostly dominated by men. And it is so interesting to sometimes just read the crap that they write and where they are, like they're all still waiting for the market to bottom out. And I'm like, dollar cost averaging. I got better things to do than read your weird stuff. So yeah. I had a different question for you, Sarah. I don't know if anybody else is wondering this, but if you get new clients that come in, do you give, I didn't know if you had like a baseline of diversifying like percentages for different asset classes. If you kind of like everybody, maybe you do, a 20% in different asset classes, but then you tweak that percentage for each individual, based on what's going on in their life, or is it literally, completely free for all? Like you don't ever recommend a certain diversified percentage at all. Like I didn't know what your take was on that.
Like starting, like how much should I have in stocks? That question?
Yeah, like just how much in stocks versus bonds versus what, the different international stock, like if there's any kind of, guideline that you personally recommend, or if you literally just take every individual person into account and base it on an actual person.
Yeah, I mean, just like with my practice, I try to take everybody's personal thing into account, right? Because it's a function of age, assets, how much risk do you have to take, how much growth do you need, how much safety can you afford, kind of all of these things, plus temperament. Some people hire me because they don't have the temperament, so they're like hiring my temperament. So there's that part of the relationship to navigate. So I would say when I am doing it, it's very much custom, kind of starting from scratch. I think that for like most DIY people, people tend to think that you're either all in or you're all out, right? So if someone even starting from 50-50 and then seeing how that goes for a while, I think is at least a good place to start, instead of kind of thinking like, oh, I'm all in or I'm all out. You can also, like, if you want to know the percentages that Vanguard suggests, look at Vanguard's target date retirement funds and see what their allocation for someone of your age would be, right? So if I'm retirement 40-40, maybe, like what does Vanguard recommend for me? It's something like 80% stocks, 20% bonds. So that's probably a decent place to start for DIYers too. And then like adjust from there. Awesome. We've got 9 minutes left. Oh, and Gwen wanted me to cover the last slide. Sorry, y'all, let me pull this back up if I can figure out how to do this. Can I share my screen again, maybe? Okay, so this last slide, okay, you're using the chat box. My email address is up here. Just to reiterate, our next meeting is on May 23rd. I don't know if you guys can see this. I can't get it to go full screen for whatever reason. Here we go. So make sure you RSVP either on the meetup group or on the Facebook page so that you can get the link to come back here. So Lori and I will like switch roles, I'm guessing. She'll be the presenter, presenting especially like how DIY investors can get started investing. I'm assuming we'll cover something like accounts, like the logistics of investing. This is a little bit more theoretical, but like the logistics of investing. And I'll be the moderator, but please mark your calendar for that. And then I think maybe we have time for a couple more questions. Lori?
We pretty much covered all the ones that people asked. Lots of people were answering as we were going along. So thank you so much for everybody who was giving each other answers in the chats.
Oh, that's awesome, you guys.
Yeah.
Is that what I saw? I saw people clapping about something. Was there some clapping happening in the chat, in the group chat? No. I saw people clapping about something. I don't know what it was.
I don't know.
QC joined us from China, and it's 5:30 in the morning there for her. Maybe that was
that's so cool. Oh, awesome.
Yeah, and she's been providing a lot of input to people too.
Oh, I love the chat. Yeah. Oh, I'm so happy, you guys. Thank you.
Sarah, this is Caitlin again. I have a quick question. How often does the S&P or the Vanguard Index Fund kick off, like reevaluate and update their list? Is that a yearly thing? When will they get rid of the companies that are doing poorly in this? Do they want to keep it steady? What?
I think it's annually.
Okay.
Like if the companies stop meeting the criteria, and you can go to the S&P website and find the criteria that the S&P 500, that Standard & Poor's has to include people in the S&P 500. So like one of the things, like Tesla's not a member of the S&P 500. And I can't remember which rule it didn't qualify for, but it's a really big company that isn't in the S&P 500. So I think they look at it annually and they redo the list. And usually there's just like a handful of companies, like maybe 2 or 3 that get kicked out and then replaced with someone else. If you weren't looking for it, you wouldn't know it was happening, and it doesn't really affect your basket. But they do announce it and kind of put out a press release or something and tell you that it's happening if you're looking for it.
Okay.
So I wanted to talk about if you were going to buy into the market, what should you be looking at? Berkshire Hathaway, of course, is one of my favorites. His stocks are always pretty high, but they're low. And I was just listening to a commentary on Yahoo Finance where this guy was like, if you look at the big history, you don't usually see it low at all. Mm-hmm. Another one that he liked was Markel, but I'm not familiar with that one at all.
Yeah, they're very Berkshire Hathaway-esque. So
yes, he said that's why he liked it. He said it seemed like a smaller Berkshire Hathaway company to him. Yeah. And there's also other ones that seem a bit riskier right now, like airlines.
Yeah.
But some of those might potentially be too big to fail. Is like, would it be worth investing in American Airlines at this point? Apparently, Berkshire Hathaway, some of their earnings went down because of their Heinz Kraft holdings because people are going to less processed food. So it's like, okay, well, Heinz and Kraft might be one that people would typically think of to buy, and apparently now it's not a good time for that. I don't know. I don't know if anybody has had any ideas about ones that they have their eye on. Telemedicine is very popular now. Zoom, almost everybody's doing Zoom, and I think you said Ring Central is based on Zoom. Things like that. I was wondering, did anybody have any suggestions?
Yeah, definitely put your suggestions in the chat. I would love to see what everybody's ideas are. And I'll just offer like how I think about the market and what I think you can use as you are putting together your list. I think in this particular environment where there's a lot of uncertainty going forward, I think focus on profitability, companies that generate profits. And companies that have, the way we phrase it is strong balance sheets. That means you have way more assets than you have debts. It means you will have no problem. So right now we're in the middle of this crisis. One of these kind of slow motion train wreck things that's going to happen is companies that have debt that need to refinance it. If those companies aren't strong, they're going to have a hard time refinancing their debt. So that's like how this like gets drawn out and separates strong companies from weaker companies. If you're already financially shaky, it's only going to get harder from here on out. If you're already financially strong, you have the opportunity to invest money into this market, right? You can go after new customers, you can develop new products, you can develop new services. And so there's going to be this separation of the weak from the strong. And the easiest way to identify those companies is profits and balance sheet. But also, like you mentioned, Lori, it's thinking about what happens in the future. Like what are the trends that you can just, like they're just going to happen, right? And so, like you've already mentioned them. The question about like the Boeing and the cruise lines and the travel companies, I would say that if you are going into that realm, or even energy, it looks more like speculation than investing at this point, where a lot of times you're just trying to make a bet on who survives. It's kind of different from my approach, right? Like if you're like, this company is going to survive and the rest will die, that's riskier, right? That doesn't mean you shouldn't do it. It just means it's riskier, right? Like pick a cruise line, any cruise line. Which one is the best? I don't know. And I'm not super interested in like putting a whole lot of brain power into that when I can invest in something else that seems easier, an easier way to make money. But we're all investors developing our own strategies. So you should do what makes sense to you.
Sara?
Yes.
Hi, Leora.
Hey, Leora.
I was wondering what you were thinking about in terms of the future of possibly financial planning, but also some of the investing like sector categorizations changing because of the rapid shift in how consumers are buying things, like the shift to e-commerce. I'm just used to reading lots of category lists where it's like software or internet companies, and now it's like, but the internet companies are the ones selling the food and all sorts of other products. So have you seen any, it seems to me like the stock market's skipping over the millions of people who are unemployed.
Yeah.
They're somehow going to be spending if earnings are supposed to continue, but the spending is shifted to other companies by some significant percentages, at least during the past couple months.
Yeah, I mean, so your first question, I think about sectors and the industry, I think you are right on that. If we're going from really broad S&P 500 to like a certain part of the market, it is up to you to know which companies are categorized as which sector, right? So you need to go and figure that out. The way that the GICS standards, the way that chop companies up into different sectors recently changed. So you'll want to know when you buy an ETF, if you're buying a technology fund, you want to know what qualifies as a technology company. And is Amazon a technology company, or is it a consumer discretionary company? Like, you can figure that out by looking at the fund. But I think it also leaves open this question about, like, if you're thinking about what happens in the future, you can start organizing your thoughts instead of around sectors, around themes, right? Like you mentioned, like e-commerce, right? Like, what are the, who are the companies focused on e-commerce? Amazon's the most obvious one, but there's something, there are other companies in that space that they might be part of different sectors, like formal sectors, if that makes sense. So I don't know if that was a good answer to the question, but I think whenever you're investing in a fund, you can do the research to find out which actual companies are included in that fund and make sure it's who you think it is. You can do that at Morningstar.
Yeah.
Right? Or like Yahoo Finance or something. Or you just go right to the fund's website and figure out who their holdings are. Good question. What else? Oh my gosh, I'm loving this chat over here, you guys. It's so awesome. Nice list, Ruth. That looks good.
Were there any companies or themes that really surprised you that did well, or projected to do well, or not projected to do well right now? Because, for example, I looked at Zoom, and as popular as they are, I didn't see like incredible movement for them, like relative to.
Yeah, I mean, one of the things that is surprising to people is we're in the middle of earnings season. When a company announces earnings and they announce good news, oftentimes the stock won't move, or it'll go down. Remember that investing is forward-looking. That's usually because people already expected the news, right? So like, as you're going forward, there are trends that they call, the way we say it is like, it's priced in. The good news is priced in, the bad news is priced in, so that when you actually get the news that everybody expected, the market can move the opposite direction. So that's not something that, it's not something that should be surprising going forward, because it's something that happens all the time, even in normal market conditions, but it's something to be aware of as you're looking at the market. Like a company like Microsoft can announce really good earnings, like, hey, we made this much money, even beat expectations a little bit. But if they didn't beat the expectations by as much as people thought, the price can go down. So like Amazon just had this, they announced on Friday, I think, Thursday or Friday. Everybody's like, Amazon, 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 through this whole thing. They announced something that, well, they actually announced something that was a bit disappointing, and the stock fell by 7% a day or something like that. It doesn't mean you're doing it wrong, right? It just means in the short term, people are weighting different information, I don't know, in different ways right now. But I think that, like, once the initial shock, kind of through March 23rd, once people got their wits about them and started thinking about what happens next, the market reacted very quickly. The quality stocks kind of went up, and now we're kind of going sideways. And the lower quality stocks, it seems like it's a bet one day or another about if it's going to grow or if the company's going to die, right? So you see a lot of the riskier companies really like spiking, moving by a lot from day to day, where you see the high quality companies, they went up and then kind of are going sideways, right? Because everyone already bid them up, and now they're kind of going like this. So that's interesting. Great questions, you guys.
So it's a 4:35.
Yeah.